So the Fed sees economic growth cooling and inflation estimates were higher than expected and the markets rallied. We're going to talk about that today on Open Interest. Hello everybody and welcome. I'm Mike Coe. Welcome to Open Mic. We're going to talk a little bit about the word from the Fed that we got today and the market's response to it, what could possibly be going on here, and talk about interest rate expense for the government a little bit more generally, and then take some questions. We don't have Brian today, unfortunately, but we will be having Dennis Davitt on Friday when we go live at 2 o'clock. Dennis Davitt is the former head of derivatives trading at Credit Suisse for many years ago. He was also a former partner at Wolverine. I've known him for a long time. And one other thing about him, he was originally supposed to be one of the first cast members, panelists, whatever you want to call it, on CNBC's Options Action. In fact, even before that show's first episode, he appeared in the promos with me and with Stacy Gilbert from Susquehanna. And unfortunately, due to concerns between General Electric and Credit Suisse about potential conflicts resulting from investment banking relationships between those two companies, he didn't end up doing the show. But he will be joining ours. So be sure to tune in on Friday at 2 p.m. Eastern so that we can talk to Dennis. All right, so interesting results today from the FOMC. And I have these numbers over here. So basically, the estimates for inflation that came, this is from Jerome Powell's comments earlier, that they raised their median estimate for so-called core inflation, and that strips out food and energy prices. And, that's, kind of important. As we talked about on our prior episode, food prices obviously have been up quite a lot over the course of the last couple of years. So after you do that, the end of this year is now 2.8, up from 2.5. So 30 basis point increase in the full year core inflation estimate. And at the same time, they reduced their outlook for 2025 economic growth from 2.1% to 1.7%. So a 40 basis point cut there. They left the rates unchanged. They did indicate that they may not run the balance sheet off quite as quickly. I'm assuming that is, and according to Jerome Powell, you can actually verify this information yourself if you're interested by going to the Federal Reserve's website, that the balance sheet had decreased by about $2 trillion. So slowing the pace of that essentially would create some additional support, if you will. And that could, I suppose, be viewed as somewhat dovish. He did repeatedly refer to the Fed's dual mandate of, controlling inflation and maintaining full employment. And I suppose if there had been more of a focus on inflation exclusively in conjunction with those higher interest rate estimates that they have for the full year, that would have been viewed negatively as somewhat hawkish. But it was not, because one of the things that they referred to was that they're well positioned to stay the course effectively if inflation remains higher than expected. So not hinting at any possible rate hikes, just slowing the potential path for rate cuts. I guess that would be the best way to read this. Now, I had talked about this previously on the front of interest rate expense, and I just wanted to touch on this possibly with some graphics. I think I showed this last Friday. What we're looking at here is the maturity schedule for U.S. Treasury, for U.S. debt, right? So these are the debt instruments that are going to be maturing this year. It's close to $9 trillion. Next year, about $3.8 trillion. The next year after that, about $2.7 trillion. There's some slight differences between this and a separate calculation that I did on these estimates. But one of the things I wanted to point out, and this was really fueled by a tweet that I saw, and it just reminded me that there seems to be a little bit of a misunderstanding at times about how interest rate expense changes through time for the federal government. What are the potential drivers of it? Now, I don't know if I'm going to be able to find that tweet. I'll scroll through it. It's not really terribly important. I had simply pointed out that the interest rate expense for the year to date, was looking like it was going to be on a run rate for 1.1 trillion or so. And someone tweeted back, Trump is going to make that go higher. Well, I want to just point out that there are some things that are going on here that are not really within the executive branch's control at this point. What's happening to interest rate expense for the federal government at this point really was dictated by policy choices that were made by the prior administration. And I wanted to highlight essentially what those are and what the net impacts are so that people can begin to understand whether federal spending cuts, for example, are going to result in, some have proposed rebate checks to taxpayers or, whether it's going to hurt the economy and things like that. Now, I don't expect those rebate checks. Maybe the administration will try to promote them, but let's just take a look at what's going on. So far this fiscal year, from October 1st of last year through the end of last month, so 5 months, we've paid $478 billion in interest expense. So just running that out at the current, if we maintained that same pace, I'm not saying we would, should, or could, but if we maintained that same pace, that would be about 1.15 trillion for the full fiscal year. So that's 12 months, but that's the 12 months ended in September. But let's just start with that as an annual interest rate expense. Having these numbers be completely precise isn't the important point. The more important point is how those interest rate expenses are going to change and how meaningful they are, regardless of what the administration does. Because what's going on is we have all of this debt that is maturing, and we need to roll or refinance that debt. So what we have here is a compilation, and I'm only looking out for the first three columns of, and I rounded these out, right? So I just called it 9 trillion, 3.8 trillion, 2.7 trillion, and so on. Again, round numbers are good enough. Now this number over here is the weighted average coupon for the debt that is maturing this fiscal year. So this 9 trillion has a weighted average coupon of only 0.9%. And the reason this is true is because in the prior administration, when Secretary Yellen was financing the debt and deficits of the government, she issued a lot of very short-term debt at a time when short-term interest rates were lower than 1%. Now, at the time, 10-year rates were less than 1.5%, or at the time that a lot of this was financed was less than 1.5%. So at a time when a lot of people were refinancing their houses with 30-year fixed at 3.5% or whatever it was, and we could have financed some of this debt and deficits at, call it 1.5% or 2%, that didn't happen. That lowered interest rate expense during the Biden administration, but it's going to materially raise it no matter what during the Trump administration. So what we have here is, I'm assuming that, let's say you have a 4.25% 10-year rate. That's in this upper left-hand corner here where my cursor is. That is about the rate of 10-year treasuries right now. We could change this. We could say, well, what about if you finance it with 2-year paper? That's about 4%. And you'll see that the rest of these numbers change. So let's just start with that 4% number and say, okay, let's just push it out to the midterms. Well, just the debt maturing this year, when you finance it at 4%, the 2-year rate, results in $278 billion worth of incremental interest rate expense for the federal government. Now, why is that number kind of an interesting one? Because that is actually bigger than the reported savings from DOGE, the Department of Government Efficiency. So according to usdebtclock.org, great website, by the way. I have no affiliation with them, but if you want to sort of get your arms around what's really going on, and put some numbers to everything, that's a great source. usdebtclock.org. I highly recommend it. They've got about $220 billion worth of savings. So if you save $220 billion in government spending, just the incremental interest rate expense for rolling the existing debt, and that does not include the incremental interest expense for this year's deficit, which is running at around $2 trillion. So that's the number down here. That works out to about $320 billion, or $100 billion more than the DOGE savings. Now, why is this important? Because interest expense, while the government does have to pay it, doesn't get calculated into GDP. It's transfer payment. Whereas the DOGE savings cuts on the government spending line by about $220 billion. $220 billion on, and we're going to just use round numbers on a, call it 30 trillion economy. So that's 73 basis points coming off of GDP using a multiplier of 1. Whether you should or shouldn't is a separate issue, but let's just think about it that way. So that is kind of what's going on here. Now, I did a little bit of additional work, and what you can find is that if you just stack up all of this incremental interest rate expense over the course of the next 3 years, so that's assuming we can't get the deficit down, which is going to be very difficult to get the deficit down, because if every time you save $1, you end up paying an extra $1.50 in interest rate expense, you're not making any headway. It's getting worse. You're just not getting worse as fast as it would if you didn't make those savings, but it's still getting worse than it was. So really, just to sort of keep things where they are now, which is way too high in terms of the deficit, that's what would have to happen. So that incremental interest expense alone, there's about 110 million taxpayers in the United States. Just the additional interest rate, just the interest rate expense per taxpayer, so this is the incremental plus the existing, is almost $15,000 per year per taxpayer. Interest expense. So if you're thinking about whether or not the government needs to get a handle on its spending, I would like you to just sort of think about that number. And then I kind of thought, well, you know what? While we're at it, why don't we just think about spending a little bit more? So this is also additional information. You can find it, but I thought this is kind of interesting. There's about 134 million full-time employed people in the United States. And in the aggregate, they are earning a little over $15.4 trillion per year. Now, most of you probably know that the federal government's spending about $7.2 trillion. You probably don't know what state and local governments are spending. That's another $5 trillion. So that gets you to about $12.155 trillion or so in federal spending. So if you can imagine, if there were no other taxes but income taxes, and the average American worker was getting $115,000 salary, we can imagine that the median is much lower because there's some people at the high end of the distribution. But that basically means that only $24,418 per year is left over if income taxes simply covered all of the federal, state, and local spending. So, again, the reason I point all of this out is simply because for those who think that this is just simply an issue of, taxing the wealthy more, well, imagine that you just simply put a cap on it and you just said, you know what? We're going to tax every nickel you make above $24,500 per year. Every working person has to pay everything they make over $24,500 per year. That would be insufficient. Those taxes would be insufficient to cover government spending. And if that doesn't open your eyes, I'm not sure what does. So that would mean your doctor makes $24,500. You would actually be, in fact, you can figure it out. You'd be short by about $100 per taxpayer. So you wouldn't be massively short. You'd be about $13.5 billion short of paying, the current spending. And by the way, that spending is based on this year's spend. Not next year's, which will be higher, or next year's after that, which will be higher. Again, because of these higher interest rate expenses. So it's something that they definitely have to get a handle on, and hopefully they will. So again, do some of the math yourself. Might be interesting. It is a little bit concerning to me because the path that the administration is trying to navigate right now is that they're trying to get some spending under control. But even if they do, it seems to me interest rate expense is going to swallow up a good portion or all of it. Cutting spending is going to cut GDP. If they can cut the trade imbalance, that would improve GDP because you have to factor in net exports. And I think that's a lot of what the tariffs are about. And of course, they can't really directly control taxes because that has to be done by Congress, but they can control tariffs. And so I think, if you imagine it like that, I've previously said that gives you some perspective, I think, on what they're probably discussing behind closed doors. And maybe, I don't think it's particularly complicated. This is my conjecture, by the way. Don't have it from anybody on the inside that this is the way they're thinking, but their behavior certainly lines up that way. Okay. So, with that, let's take some questions. Steve Garcia, adapted your Tesla 2-by-1 put ratio suggestion. So yeah, let's take a look at this because this business with Tesla, and you had you have the 210 185s. For a tiny credit. Okay. And it's April. Okay. So let's see if we can just draw a little picture here. Oh, I'm sorry. So, yeah, hang on. So, my mistake. Okay, I thought. All right, we're gonna get to Tesla in a second. I see that somebody says that Cantor Fitzgerald, my old shop, is saying to buy it. I'm actually going to take a look and see whether that's it's honestly. I mean, it's been more than 10 years since I worked at Cantor. The chances that the person who is the analyst for Tesla is the same person who would have covered that stock when I was there is pretty slim. So there's a decent chance I don't know them. But if I do know them, maybe we can reach out to them and just see what their thesis is and talk a little bit about mine. So let's get to this first question here. So I adapted your Tesla 1-by-2 put spread to, yeah, I should have got to be very careful. Read the whole question. Don't just start bouncing around as I just did. So very similar chart, by the way. Okay, so let's go like this. You have it out to April, and you put this thing on for a credit. All right, so that basically means, so just so everybody understands what's going on here, I'm just going to draw a couple lines on here. So buying 1 210 put, which is right about there-ish, give or take, and selling 2 of the 185 puts, that's right about here. It's close enough for government work, shall we say. And you put it on for a slight credit. I'm going to assume that you got that thing on for even. So that whole spread then, 210, 185 is $25 wide. $25 below 185 is 160. That's essentially your break even right over here. Okay. Now, oops, should have done that before. All right. I wanted to have a bigger chart in there. So I have to draw those lines again. Sorry about that. 210, 185, 185. And then I'm going to explain for anybody who doesn't know what this trade is and the way to think about it. That's close enough. And then 160. Again, that's close enough for government work. There we are. Okay. That's interesting too. Take a look at this over here. I don't know if you can see this. There's an unfilled gap right over there, and then basically nothing. Okay, so the 1-by-2 put spread. Buy one put, sell two of a lower strike. If you can get that trade on for even, it will make the most money that it can make at the short strike. And the amount of money that is the difference between those two strikes. So in the case of the 210-185, that's $25 per share, $2,500 per contract, each contract representing 100 shares. Of course, because you are short two puts and only long one, effectively, once you get to that short strike, you are now short a put on balance, right? Because you're long one, short two. So one offsets the other. Now you're basically short one. So what's going to happen is your profits are now going to start to dwindle as the stock goes lower and lower. And your downside break even will again be the distance between the strikes from the short strike. So 210 minus 185 is 25. 185 minus 25 is 160. 160 is your downside break even. So the downside in this trade is that Steve is going to be long Red Hat at $160 a share. That's why I wanted to put up this 5-year chart, because we can see that the stock actually hasn't traded down to that level in quite some time. And these are I like these trades in this kind of environment. Stocks that have been hard hit, where I think there's a potential for some further weakness, but maybe I believe that most of the damage is done, and at the very least I'm willing to get long the stock at a lower level. For what it's worth, I put on a 1-by-2 in Nike today. They're going to be reporting earnings, and the market's implying a move of about 8%. It's had some pretty big moves, but Nike's done pretty poorly lately. So in general, I like that trade. So now let's think a little bit about what things look like if you actually end up getting put the stock. So one way I like to look at these trades is, okay, let's assume that the worst happens. So the stock's trading 230 right now. You would get long at 160. So that is about a 30% discount to the current stock price. And so 30% of the current stock price is a little over 1.2 billion. This is an important thing to think about right here. I don't know if you can see this, but so the enterprise value of this business is 8 billion, right? So when you have that kind of leverage on the balance sheet, a $1.2 billion decline is actually only about, well, I'm just going to use 8. That's about a 15, yeah, because it's about 50-50 debt to equity, is only a 15% decline in the enterprise value of the business. So it's a discount, and it's a decent discount. And as we saw, that gets you back to where the stock was trading several years ago. But it's, in fact, actually, let's take a look. So when was the last time the enterprise value? So 2020, February of 2020. So this is, we had an enterprise value of about 5.7. So let's now think about what that means. All right. And let's also hope that these forecasts for free cash flow are reasonable. Okay, so this is the full year free cash flow. Your risk, remember, is going to be that you get long the stock at a $1.2 billion discount. So that's $6.8 billion. So 185 million over 6.8 billion is free cash flow yield of about 2.7%, assuming that the company achieves these numbers. Now we can also take a look at this in terms of price to earnings. So price to earnings, we're going to use a different numerator and a different divisor. In that case, our numerator is going to be 264 million full year estimated earnings, and our divisor is going to be the market capitalization, which is going to be the current market capitalization less the discount to which you would be buying it. So that's $160 a share. That's a 30% discount. That's $3 billion. So it's $3 billion divided by 264 million is a forward price to earnings multiple of 11.4. So that seems That seems quite reasonable. So in short, to answer your question, and just for people who are looking at this and just trying to think about it, that's kind of the way I would like to look at it. You could also, and probably should, in addition to free cash flow yield, depends on the business, right? EV, EBIT, at where, you know, at whatever level it would be put to you, free cash flow yield, price to earnings, looking for, you know, at what points you would have been able to purchase it at these levels. And actually, did I say, I said Red Hat. I didn't mean Red Hat. This is Restoration Hardware. And Restoration Hardware, for what it's worth, is based about 2 miles in that direction. Literally, Restoration Hardware is right up the road from me, for what it's worth. So I should have had that right offhand. And anyway, so yeah, I do like that trade. Alex V. Cantor Fitzgerald. Now let's see who's covering it at Cantor. Do I know them? Andres Shepard. Nope. Don't know him. Don't think I know him. I should probably double check my LinkedIn. And if you, and Andres, if we do know each other and I for some reason don't remember and claim I don't know you, that's just because I'm a schmuck. So, no. All right, now I've got a picture of him now. Let's see here. Oh, you worked at Bloomberg. Okay. All right. So he went to the University of Michigan, got his master's degree there. It's also where our good friend Professor Mark Guthner got his graduate degree, the Ross School of Business at Michigan. Okay. Tesla. I don't know. I'd be very curious. You know, people can put into the chat, please tell me where you're joining us from. And I'd be very interested to see if you all are experiencing the things that I have seen. Now, bearing in mind that Northern California is going to, you know, it's a political microclimate, as every region is. But what is interesting is that, so we have a Tesla. We parked behind one recently, and the bumper sticker on the car in front of us said, "We bought this before we knew he was crazy." I have driven by, actually right across from Restoration Hardware is where the local Tesla delivery spots. I don't really call them a dealership. It's not so much a dealership. I guess it, you know, it's a factory-owned store, company-owned store. And, you know, I go by this thing very regularly because my kids use a gym very close to it. It's also where we've picked our Tesla up. And, you know, there's people out there protesting, you know, waving picket signs and all kinds of stuff like this. As far as I know, nobody's burned them up. I haven't seen or heard anything about that, but it's a difficult one because I saw somebody say, you know, he should take the company private. And he had previously said, you may remember, pre-split, oh, I should take it private at $420 a share, which was a joke based on the number 420. But the thing is that, you know, if it depends how you value this business, but the floor for Tesla, and I actually had thought that this pullback was probably, you know, a good reason to think that it was due for a bounce. And there are plenty of people who are bullish on the stock and trying to take advantage of this. But I just want to issue this one bit of caution, which is that if this stuff that's going on persists for too long and people are deterred from buying the cars, it does create real problems because this is not priced like a conventional auto company. It's priced at an enormous premium, and it's, you know, so there's a lot of good news baked into the cake, even now, believe it or not. So, you know, 2026 numbers, $3.85 a share, right? And I advised a 1x2 on this thing and did say that I expected it to bounce. That's 61 times forward earnings on a 37% growth rate. the company has things that nobody else has. They have more data, and data is critical in the full self-driving arena. And, their cars are phenomenal at it. I was just talking to a friend of mine who actually came by the house because his Tesla was out of charge. He was at a nearby coffee shop, needed to plug in and get a couple miles to get to the nearest supercharger, which isn't far. But, we both said, look, these cars are phenomenal. The full self-driving technology is remarkable. They've got the data. They have done it in a cost-effective way. They make these cars profitably, which nobody else seems to be able to do. So there's a lot of reasons to really like it. They've got this robo-taxi business. They've got the full self-driving technology stack, which they can use for the robo-taxi, or they could potentially sell some of this information or technology to others. And they have robotics going on. There's just a lot of good things going on at this business. But I think it is also worth noting that it's not like the company is really, really cheap. So I would play it from the long side, but I would use a tight stop on this. Or, do what I was talking about. Because the 1x2 put spread that I advocated, I don't know if it was the last live stream or 2 live streams ago, but the 1x2 put spread, the idea there was that it could see some further weakness, and then you get the stock put to you at a lower level, and not an immaterially lower level either. So if you did something like what we were just working out in restoration hardware, like a 210 185 for even, then you're getting long the stock at 160, and this company actually has net cash on the balance sheet. So to put things in perspective, 160 over 235, so that's a 32% discount. But that's a 32% discount off of the market capitalization of, we'll call it $760 billion round numbers, which is $243 billion off the $736.5 billion enterprise value. And, now you're getting down to a 2% free cash flow yield if they can get next year's numbers to hold up. I think that's very reasonable. And if vol comes in, that's a trade that'll probably do all right. And if the stock comes in a little bit, you can do all right. Bear in mind that these 1x2 put spreads are probably going to be long delta. So as the stock rallies, you're going to make a little bit of money and be able to take it off. If the stock comes in, then you have to wait for time to pass for profits to accrue, because you're short 2 puts, long 1. That's probably a way that I would think about playing it. By the way, I happen to notice another person's name in here who's got a buyer and overweight. What does he have? Outperform. Ben Callow over here. So for those who don't know, Ben Callow, nice guy. Also Melissa Lee's husband. Okay, so let's move on. Tucker D. Dog says, DOGE not going to hit their predicted savings if judges keep reversing and undoing their cost savings measures. No, I suppose not. And I assume they can appeal. We'll leave that to the courts. We have 3 branches of government, and that, and I believe in that, by the way. So whether or not I think they should be able to unilaterally do things, it's a cumbersome circuit breaker at times, but everybody, regardless of what political stripe you have, you should be pleased that we have multiple branches of government keeping an eye on each other. Okay. Eileen says, the government should have you advising them, like, can we nominate you anywhere? Boy. I don't know. I don't know that they need me to advise them. I'm just simply trying to, and by the way, nothing I have said this is why I said it was my conjecture, that this is the conversation they're having behind closed doors. I don't know Donald Trump. I've never met him. I don't know Elon Musk. I've never met him. I don't know Scott Bessent. I've never met him. I do know Howard Lutnick. We're not friends, but I work for the guy, and I've spoken to him one-on-one on more than one occasion. And when I imagine them behind closed doors, basically the conversation I just had with you is very much my guess as to what they're discussing. How do we cut government spending, keep inflation down, and try to get rates down so we can refinance the debt at a reasonable number? Can we somehow use tariffs to generate a little bit of short-term revenue, number one, and also reduce the trade deficit, number two, because reducing the trade deficit helps GDP. So I'm guessing, look, these are very smart people. Many of them are a lot smarter than me, I'm sure. So, and maybe some of them aren't. Don't know. If they called me up and said, hey, you want to come to Washington and work with us? I think it's important work. Of course, I would say yes, but it won't surprise me when the phone doesn't ring. Okay. PC says, on Accenture, unusual whales gives an expected move of $17.50, so the standard deviation is 874. What is your calculation value? Okay. So just a quick point of order. The expected move, half of the expected move is not the standard deviation. The statistical term for half of the expected move is the mean absolute, it's the mean absolute deviation is really the number that you've come up with. Well, let's take a, actually, I'm talking hypothetically. Let's see what's going on here. So the expected move is the mean absolute deviation, and they are announcing, so today's the 18th. No, today's 19th. I should know that. It's my son's birthday. Gave him a couple bucks in his birthday card before he took off for school this morning. So, of course, I should know it's the 19th. Okay, so they are going to be reporting this week, and the straddle, the at-the-money straddle, is going to give us the expected move. That expected move is on the offer, 1040 to 1070, but let's just pick the midpoint. So $10 for the call, and that put $1.70 wide. I don't think it was $1.70 wide before the close. That's probably just a closing print. Let me just see what it was beforehand so we can tighten that up a little. Let's take a look at it as of 15:45, and it was not $10 with the stock right here. So it's $20. Okay, so the expected move is $20 by the end of this week over 325 is 6.15%. The expected move, as I said before, is the mean absolute deviation. The mean absolute deviation is the standard deviation multiplied by the square root of 2 over pi. Is that important? No. Remember the number 0.8. Take the standard deviation, multiply it by 0.8. That's going to be your mean absolute deviation. And actually, any of you guys are, you're having you go to a cocktail party and you want to perform an interesting trick for people, impress them, if you will. You'll be able to calculate the value of a straddle. If someone just says, oh, I'm looking at such and such a stock, I don't care what stock it is, Tesla, you pick the stock and they say, oh, such and such stock is trading 32 vol. And you could say, what expiration are you looking at? You'll be able to figure out the value of that straddle, right? So if it's 1 month off, you take the square root of the amount of time in a year. So if it's 1 month away, you're taking the square root of 12 because there are 12 months in a year. If it's one trading day away, it's going to be, you divide by 16. So the square root of 12 is 3.46. You divide 32 by 3.46. That is going to take that number and multiply it by 0.8, and that's going to give you the value of the straddle. Interestingly enough, for whatever reason, back in the day when I was a floor trader, people were always surprised that I could, come up with an estimate for the value of an option in general, but it's really not that tough. And if you have an HP12C or you have your iPhone, it's going to be even easier. But you can do this stuff without a model. If somebody just gives you the price of the stock, time to expiration, and a vol, you'll know what the straddle is. So, the short version of this is this. So yeah, so it's not the standard deviation. 8.74 is actually 1/2 of the mean absolute deviation. And my expectation for the expected move is just based on the straddle, which is 20. So can implied volatility smile be used for strangle swaps iron condors by inputting the first and second expiration dates? Can the implied volatility smile be used for strangle swaps iron condors by inputting the first and second expiration dates? I'm not sure I know exactly what you're asking me here. So this question could be related to... So let me just offer something. If you're thinking about a strangle, a lot of people will say, oh, I want to sell a 20 delta strangle. And the smile impacts the strikes when you're calculating what that strangle is so that they are not equidistant from at the money. So that's how a smile might go into a strangle or a strangle swap or anything like that. Let me show you what I mean. So why don't we use restoration hardware? Because restoration hardware, because it's 50-50 debt to equity, probably, I haven't looked at it yet, but it probably has some decent put skew. Let's take a look. And sure enough, it does. Again, not surprising. Equity is going to get more volatile as the stock price declines because the amount of leverage for every dollar worth of equity is increasing as the price goes down. If you have a company that has a lot of cash on the balance sheet, like Berkshire Hathaway, for example, we can take a look. You wouldn't expect to see that. So let's just do this really quickly. Might as well show you, since sometimes it's helpful to see a picture as well. So this should not have a lot of negative skew. It actually has more than I would have expected. Should sell downside puts in Berkshire. That shouldn't be. Do risk reversals in Berkshire Hathaway. That's my takeaway on that. Because cash doesn't have a whole lot of volatility. Unless you're in Zimbabwe or Argentina or something. But generally speaking, cash doesn't have a lot of vol. So what that means is that if a stock is 50, if every dollar's worth of equity price is represented by 50 cents worth of cash, because cash doesn't have any volatility, as the price declines, the volatility of the stock should actually be going down, not up. A simple way to think about it is that if the stock declines by 25%, say it goes from 100 to 75, but there's still $50 worth of cash, well, now 2/3 of the stock price isn't moving around. It's just cash. So you shouldn't expect to see this. But, you know, sometimes people don't price things right, and this might be an example of that. Okay, so let's just quickly, again, we were looking at restoration hardware. So looking at the smile, let's imagine that you were going to do, you know what Tom Sosnov and Bat and all those guys like, selling 20 delta strangles, for example, that expire in, that's probably not far enough out. I'll go out to the end of the month. I'll go to May. It's going to be close to the time that they like. They like 45-day strangles. So what's that going to work out to? So the 20 delta put is going to be, stock's 230. The 20 delta put is now going to be, we'll use the 190, close enough, right? So 190 or 230 is $40 away, and the 20 delta call. Let's see. Well, actually, this is just showing you the smile. Let's take a look at that vol too, real quick. So 190. Implied vol mid 89. It's also going to be a function of the price. So then we go up to 20 delta here. So I've got to blow this out. I need more strikes. Can I manually type them in here? Let's try it. And your 20 delta nears makes no difference. It's going to be the 305. And actually they have the exact same volatility effectively. The other one I think was 88, and this one's 80, so it's pretty close. So actually this is a fairly symmetrical smile. Here too, I actually would expect this to have more put skewness because of the leverage on the balance sheet. It's 50-50 debt to equity. It's probably one of the reasons that 1x2 is not a, Interesting. Okay, so let's see if I can turn on calc mode. I just want to see if I can just show you a couple things here. So what's going to happen is if you, or actually maybe there's probably a better way for me to do this. So I'm going to take that 20 delta option, which we said was the 305. So I'm just going to put that over here. Now we're going to modify this thing. Oops. Come on. All right. So here's what I want you to watch. Keep your eye on. I'm going to put so you can see the Greeks over here. Oh, look at this. This thing's now saying this is a 20 delta. That doesn't make any sense. It's still the same option, right? 305s. And here's the reason. It's because of the vol that's being used, right? So we know that the vol of this is 80. Watch that delta, 20. See that? So as the implied volatility of an out-of-the-money option increases, its delta will rise. If it's an in-the-money option, it will actually fall, because what you're really doing is the sum of the call and the put have to come out to zero. But it's extending the amount of time till an option expires or increasing volatility have a very similar set of effects on the option's value. So when you're looking at the smile or the skew, just understand that the more call skew, I'm trying to think about it from your side. Yep. So the more call skew, the more the calls get bid in implied volatility space, the out-of-the-money calls, deltas will rise. And in the other direction, they will fall and the puts will rise. And because of that, the strikes that are 20 delta are going to move up and down, right? So as call skew increases, the strikes are going to move higher for both the 20 delta call and put. And as put skew increases, they're going to move the other direction. So if the question is, will the smile, that is the shape of that volatility surface, will it impact the strikes that you choose, whether you're just doing an iron, just selling a strangle, whether you're doing a strangle swap, or any of those things, the short version to that question is yes, it will. But now, I may have just given a lesson on something that has nothing at all to do with your question, because like I said, I wasn't 100% sure if that's what you meant. Dennis, Shawi, great channel. Any chance for an SPX gold and Bitcoin comparison going back to 2008? Well, first of all, Bitcoin's early days, I don't really know that it was very representative of much of anything, because it was really obscure in those early days, and there was no real liquidity. So I was not a super early Bitcoin adopter the way my friend Darkside, who was on the live stream recently, another one of my former bosses, founder of Dash Financial, was. Wish I had been. You know, at the time, it seemed like kind of I valued the exercise. I liked the way people were thinking, but I didn't think it was going to get that much adoption. And in truth, I should have just treated it. I viewed it much the way I think about money in video games. And obviously, it probably would have been a reasonable thing to just go out and buy some. You know, a couple $100, $1,000. You know, you go out for a really nice dinner in New York City with, 4 to 6 people. You could drop $1,000 on that pretty easily, and you just put $1,000 on it, and away you go. But its performance, the price action in Bitcoin in those early days, isn't really easily compared to more liquid markets like equities and gold. And to put things in perspective, somebody else I know, I won't bother to mention his name, but he's another fintech entrepreneur, very successful one. Runs he started a financial technology company and has done very well. He was one of the first people I knew who did a really big transaction with Bitcoin. So it turned out that Audi of Manhattan in New York City was accepting Bitcoin, and he was kind of a car guy. And he decided he wanted to buy an Audi R8, and he bought it with Bitcoin. And I remember that it moved Bitcoin something like 10% when he did it, because they were taking Bitcoin simply as kind of a, it was a sexy idea that they were doing it, but they really didn't want to wear the Bitcoin position. So he goes over, he pays them in Bitcoin, and the first thing they did was just dump it, and they dumped it at the market. They apparently weren't very good traders over there. They didn't try to work their way out of it. And one Audi R8 affected the global price of Bitcoin. That's how long ago this was. But that was, I think, Jay, who's one of the producers, he may remember when that was. He may remember that. But he should have held on to... Yeah, so what he's saying, should have held on to the Bitcoin. I know somebody who bought a pizza with Bitcoin in Austin. And when I saw him and we talked about it, at that time it was 2015, and he told me that that pizza cost him $20,000 because that's where Bitcoin was at the time. And like I said, it was about mid-2015, if my memory serves me. So let's take a look at what that thing really cost. Let's go back to 2015 here. So in 2015, $200. So that pizza was not $20,000. It was, at current prices, we'll call it $85,500. Why not, right? So that pizza cost him $8.55 million. There isn't really any way to compare Bitcoin's performance to these other assets if we use the same time scale. But there is a way we can. And that's this way. If we look at Bitcoin in terms of its logarithmic growth. All right, it's just on a different time scale. That's the way I would think about it, especially more recently. Remember what I said, these early days can't really look at that because, as I pointed out, so there's a line, okay? And now let's take a look at a different one. All right. And we'll just put this in here. So this is really, I think, one way to think about it that might be more intuitive. And that's probably not the best way to do it, but whatever. Okay, so we have a line there. So let's go back like this. See? So the way to think about it is in logarithmic terms, logarithmic growth. And one way to think about why this might make some sense is because the quantity growth of the underlying asset is getting exponentially lower over time. This is not true, for example, for equities, right? The value of equities and the amount that's there, that's not necessarily true. But in this, it is. Why? Because there's a finite quantity, 21 million, and due to the halving, they become progressively harder and harder to mine. And demand, meanwhile, was following kind of a hockey stick, right? So this first period, like I said, this is not really relevant because it was an obscure instrument at this time. Nobody really knew or thought much about it. It's only more recently that it became commonplace for people to, you can go to any person on the street. You could go and talk to my kids. They know what Bitcoin is. Everybody knows what Bitcoin is now. But in this early period, if I had said Bitcoin to most people, I don't think they really would have known what the heck you were talking about. So what you can see is that there is some pattern that is related to the demand for a good, the supply and availability of that good, and time. And in this particular case, you had a hockey stick in demand, and you can usually see those kinds of relationships and compare them over different timescales by using something like this, which is a log chart. Let's take a look at gold. Now, it's annoying because I should probably just get spot gold but GLD's been around for a while, but we'll just go like this. So, now we've got gold up here. Oh, this is Peter Schiff. So if anybody doesn't know, Peter Schiff is, he's I think we could call him a gold bug. He's a big proponent of gold. And let's just go back. This does not go back to 1990. I think it starts in 94. Is that right? Or 2004, excuse me. So now we can do a quick comparison of equities. So here you have it. So since 2004, last 20 years, and you can see that the total return since the GLD ETF was introduced and that of SPY are not orders of magnitude different, right? 9.5% total return for GLD, 10% for SPY. Now this includes dividends. It does not include taxes. There wouldn't have been any taxes if you bought GLD over this period of time. So this number would actually be slightly lower. And if you'd actually owned the spot metal, there wouldn't have been any management fees, so it actually would have been slightly higher. So in truth, the total returns, he will tell you, and some people will say, oh, gold has outperformed the S&P. I wouldn't say that, because they usually only look at the price change and they don't take a look at the total return. If you owned the S&P in a tax-deferred or tax-free account, so if you exclude the tax calculation from it, their returns, equities are slightly better, but not a whole lot better. And if you start including those things, then chances are, not the same. Okay, so let's move on. I now live in James Forbin. I now live in Southern Virginia farm country. More cows than Teslas. Well, I grew up for part of my life in New Hampshire, and we had a cow at one time, and a couple of steer also. Their fate was sealed when they were named. One was named Burger Chef, and the other was named McDonald. Okay. Orange County is pretty Tesla friendly. Just opened a couple new stores. San Diego County also is quiet, but in LA County, not very happy people. Yeah, I think that's an important thing to remember. Even in California, I think people think of the state of California as a monolith. It's not. But if you live in the Bay Area, or if you live on the west side of Los Angeles, you're probably dealing with fairly similar political stripes, and it's an issue. Tucker D. Dog also adds TSLA headwinds, political competitors, European sales declines. Yeah, so in Europe, it looks like they're under considerable pressure. Now, the European issue has really got a couple things going on, which is that we are increasing tariffs on European vehicles. And we have a reciprocal, the proposal is something that's reciprocal. So if the average in Europe is, call it like 10%, right? So the duty in the UK is 10%. Then they have the value-added tax, and that floats around. But the value-added tax applies to all cars, so that's not just a Tesla thing. But if, depending on how this tariff thing goes, if they recognize that we're imposing a reciprocal tariff, they don't have an incentive to raise tariffs on our cars. If anything, they have an incentive to lower it. Maybe they will. And if they did, that could be a positive. And sort of the negative stuff that we saw regarding Tesla coming out of Germany and so on, maybe not. Anyway. Okay. Let's see here. Honolulu. Tesla is everywhere. Probably see 4 at every red light. I did see one car with that same bumper sticker, but I don't see or hear of any protests. It could be. This is a pretty politically active thing around here. Protests in and around my neighborhood it's part of the culture. So much so that one of my son's friends, one of his good friends, he plays basketball with him, and is sort of an activist family. The back of their cars are covered in bumper stickers. They they make it a point. On the weekends, they go to protests. It's like what they do. So they're not some of these freaks that are going and sabotaging people's cars, keying people's cars, breaking windows, starting fires, or anything like that. But, it's their way of, being politically active, and they think it's important. And, I embrace everybody's right to free speech, even if I don't think they're saying the right thing. Monday morning quarterback, Orinda, California. I have a Model S. Seems like each young family here owns one. Yeah, I haven't been to Orinda in a while, but when our older son his first tennis tournament was in Orinda, I drove over there. That's in the East Bay for people who are not from California. I'm in Marin, so it's not terribly far, all Bay Area stuff. PC says, on Accenture, I looked at Implied Volatility Smile in unusual whales and sold the March 28 options and bought April options for a vol trade, 305 and 345 strikes. Oh, okay. So let's take a look at that. Sold the March 28s and bought the Aprils. So a strangle swap, I am assuming, since that's a put strike and a call strike. Are you targeting an event? Sold March 28th and bought April. I see what's going on here. Okay. So you're banking on a little bit of a vol crush. And there probably will be one. I would say let's take a look back. So when was their last earnings? Let's just take a look at what that... You know what? I have another application here. Another one of our little toys. Let me see if I can just see what the average vol crush in this thing is. So we are looking at Accenture. Too close. Let me screen grab that puppy, because that data is not populating. This is software in beta. I had asked a developer to just give me something on the hop that would give me a quick... Yeah, so let's take a look at unusual whales then. I'll bet you unusual whales has got something good for us. By the way, you already use unusual whales. I see that, but for anybody who doesn't, I think we have a description, a link in the description below. And if you go and get unusual whales via that link, you get a discount, 30%. Somebody tell me. I'm not sure what it is. I think it's something like that. You get a discount. That's the important part. And so here's what we're going to do. 20%. I've just been told it's 20%. All right. So let's go in here. We'll do a little ticker exploration, and we're going to take a quick peek at Accenture. So, looking over here, by the way, this is, by the way, my favorite. I have to say, this is my favorite display of implied versus historical moves, because you will often hear people say, oh, the implied move is, and we can just hover, we can see what it is 5.4%. And then they'll give you something like the historical move is some number, which is just taking the last 8 quarters or the last 12 quarters. You know, we could just switch it over here, taking those numbers up and then just dividing by the number of instances. But that doesn't really tell you the whole story, does it? Because what you really want to know is, well, what does the distribution of those events look like? And that's what I really like about this. This tells you, so the gray bars here tell you what the historical implied moves are. So you can see that this historical implied move is bigger than all but one. That's this one 3 quarters ago. The other thing you can see is that whatever this averages out to, we've seen some pretty big moves, particularly lately. The last 4 reported quarters all fell outside of the implied moves at the time. So this one was down 9.3%. This one was up 7.3%. This one was 5.6%. This one was 7.08%. So the last 4 quarters, those are the kinds of moves you're seeing. And right now we're implying 5.4%. All right. So the next question that we have when we look at this is now we want to take a look at vol. So we're going to take a look at volatility. Go over here. Still taking a look at the same stock. So just put in Accenture. Now, the thing that we're just going to expand this because what I'm interested in knowing now is how much does implied volatility typically drop, right? Because that's how much vol crush is going to be. So this is where we are right now. This was that other big implied move we saw for that other earnings, and these are the other ones. And we can see that actually when it's fallen pretty much in each instance, whatever it was beforehand, to about the same level, right? So that's kind of what we can expect this time around. So now the only thing about your trade is that, and people who've been watching the live stream will know, that usually I kind of like to grab options that are not going to swing down quite as much because they have another catalyst in them, right? So when you get a strangle swap where you have a longer dated one and a shorter dated one, but both of them are inside the next event, it's possible that, what's going to happen is the curve is going to, let's see if I can draw a picture that shows you what the picture, like a before and an after. So we're going to look at the last earnings, and the last earnings was on December 19th. So let's take a look at the vol surface for Accenture the week of December 19th, before and after. Okay, because that'll give us kind of a picture of what we can expect. So the 19th, what day of the week was the 19th? I'm assuming that was a Thursday or something. So we'll go December 20. So this is going to be, yep, that's a Friday. So that's our after. And December, we'll go before. And we'll choose, yeah, why not? Choose the 17th. So there's our before. So we've got our before and after. Now this isn't a composite of all instances. This is just an example of that one, the most recent instance. So what you're looking at is that you are short the March 28th. So that's basically a 7-day option. So that would be this one. And you are long in April, which is basically a 30-day option. So that would be this one, right? Is that right? Yeah, okay. So you have this to this. So you're long these and you're short those. Will these come in more in vol space? Sure, right? So that one is going to get cut more than in half. But this other one, so the 1 month options that you've got, is that it? Yeah, so the 1 month options you got 32, call it to 20. That fell by about a third. So really, when you're thinking about this, you need to take a look at that trade and say, well, how much on a standstill basis do I expect to lose? That's these, the 305. So I'm just going to go OBME 2L. I'm just going to build this in real quick, so bear with me. I'm just going to build a 2-legged strategy. 305 puts and the 345 calls, you said? Okay. All right. So we'll call this 39 vol, round numbers. So that's about a 12.5 vol click loss. So again, the precise figures here, folks, aren't what's really important. It's just in general to give you some sense of it. But let's just say, for the sake of argument, that you are now going to go to, you're going to lose a third of the value on these things. So I'm just going to put the same vol in for each. So it's a $12.80 instrument on a standstill basis right now. And I'll just put in 26 vol for each of these. Oops, I lose my place. There we are. So that's $5.40. That's a steep, steep decline in the value of that strangle. So if what you're doing is you're long that, and I'm not saying that's the same thing that's going to happen this time, but we just looked in unusual whales and we saw that these are the kinds of declines that take place. The longer dated options, it's not going to be anywhere like that, is my guess. And you can kind of tell when you look over here, okay? So remember, we are now in this area, okay? So let's just take it, we're going to go back to where we were. So these were the, and I apologize, I realize this is taking a little bit of time, but I think it's kind of an important concept. So now let's just take, again, we're going to go in here, we're going to look at, let's take a look at what the options that, the longer dated ones. So here we are. If April was in the mix, it's not, because these are interpolated values. But the truth is, should not be linear. In other words, you see how this is just a straight line going across like this? In fact, if you grabbed the March or April options, these would actually be flat to higher because you'd have another event here. So this decline, which looks like it's going from about 27.3 to 21.35, isn't going to be like that. It's probably going to be more like half of that distance, maybe less. This could be flat, right? So 23, 24, yeah, so 25-ish vol. Bet you anything, it'd be right in that neighborhood. So the vol crush on the options that have more than one catalyst, when a single catalyst passes, is going to be substantially smaller in most circumstances. Now, there might be something anomalous, so you always try to dissect each story a little bit differently. But this is a really important point because this is going to, that really, the vol crush is really going to hurt you on that longer one. I hope that helps. I've brought this up a couple of times. It's not... And, sometimes, by the way, you might be playing something different. You might say to yourself, I think that they're going to make an announcement that creates additional volatility. And so, that can be fine too. But I'm just trying to say in the general case, as you guys go and say, oh, I like the strangle swap idea, I want to put them on myself, be really cognizant of the long side of that trade and the things that can pull the vol out of it. Oh, oops, let me see, let me pull this back. Where's my, all right, so I think you were just asking, all right, let me get over here. I think you were just, the question was, I think just about, looking at this. So this is you were asking whether there's a smile. So if you go into, if you have unusual whales, so first of all, you can configure these screens. This is just the default that I have. Yeah, well, it's right here. If you're looking at smile, it's right here. Right. So I'm just saying, if you're looking at the smile, and here's something else, by the way. You can change the expirations that you're looking at over here, things like that. Move the strikes around. You can take a look at volatility. You can also click these things on and off, which I will do because I usually don't like to. The stock price, for example, I know a lot of people like to look at it because it gives them context, and that's important, right? So you're trying to remember what happened. Why did volatility move the way it did, and knowing what the stock price did is really helpful. But what I usually like to do is use that as a reminder of the regime of events that we were in, but then shut it off and just look at vol. I think that's, and this, by the way, is a much easier and more intuitive mechanism than it is in the Bloomberg. I fly around in the Bloomberg, you probably noticed, but that's only because I've been banging around on that thing for 20 years. But yeah, so you have in the volatility tab, which you go to Ticker Explorer, and you have all of these things, and then you can modify each as you see fit. I want to make sure that, we have 2 pages. Am I missing something? Okay. Can you briefly explain the thought on selling a call spread risk reversal in Berkshire? What did you see today? Selling a call spread risk reversal. No. So I'm glad you asked that question, because I'm not trying to sell the call spread. I'm saying, and it doesn't have to be a call spread risk reversal. What I'm saying is that if we look at Berk B, so we'll look at Berk B here. What I'm saying is, you see how the implied volatility of these downside puts is much higher than the upside calls? What I'm saying is that Berkshire is at these prices down here, this thing is mostly cash. At $425 a share, Berkshire's 50% cash, or something like that, right? And cash doesn't have a whole lot of vol. So what I'm saying is that when you get things really out of whack, I get more comfortable selling puts because I'm selling puts on cash, and I really don't think there's a lot of risk to cash to buy upside calls. So you could do it in the form of a call spread risk reversal if you chose. That's fine. If you think that you would do that more if you thought implied volatility was too high. But what I'm saying is that if you know that a balance sheet is unlevered or is net cash, the way these are, and I don't mean net cash like a $1 trillion company has $10 billion in cash. I'm talking about a $600 billion has $300 billion in cash, right? I'm talking about Apple when it was trading and it was 40% cash on the balance sheet and generating more cash just day after day, which is another truth for Berkshire too, because they're collecting them, hand over fist in the terms of premiums. So what I'm saying is that in these circumstances, and this thing just broke out, right? So this is a circumstance where I would say, I don't mind selling downside puts in Berkshire because I don't think there's a whole heck of a lot of risk to that. And I would buy an upside call. And let's just pick one. So we got the stock trading at 525. Let's do something like, whatever. Make it a 30 delta jobby like this, right? So I'm collecting 843. And I'm going to buy an upside call for a like amount of money. Something like that. Just in case you think it sort of retreats back below that breakout level or whatever, you could do something like this. That makes good sense. There is a smile in it, so you could actually also take a look and even do something a little longer dated, because I'm not really that panicky about the downside in a name like this. So maybe I go something like a 495, try to pick up something a little closer to at the money, like the 530s, and then sell a higher strike call against it, short vol, because it should, again, cash is not that volatile, folks. Right? So what do I need? I can sell something up here. Get something like that on. So I'm, avoiding the near downside and get most of the immediate upside participation. And look, there's another reason why a trade like this might make some sense when you think about it, because don't forget that cash isn't that volatile. That's true down and up, right? The balance sheet is less levered as it declines, but cash is also not going to take off. It really, what's going to propel Berkshire is when they start deploying some of that cash and some of those underlying assets start to rise. The other thing that should happen, by the way, is that if the Berkshire crowd thinks that their company is trading at too much, that's the only circumstance where they buy the stock back, right? So they're not trying to manipulate the stock price and think about their stock options, but they look for attractive investment opportunities. And if the thing's trading below book, that's probably when they would start to buy it. It creates a put underneath it. So that's really what I was talking about. So we've been going now for an hour and 20 minutes, which is longer than I should have done. I see that a couple of you guys are here. I appreciate all of you tuning in. Like, subscribe, notification bell. And if you're around and you want to ask Dennis Davitt a question, come back and join us on Friday at 2, because this is a guy who's had a lot of experience trading. He was in the SPX options pits for a long time. And when he was at Credit Suisse, he traded a lot more OTC stuff than I did. I priced out a lot of OTC stuff, and we brokered a lot of variance swaps, mostly index variance, some single stock variance. Actually traded 25,000 big and Walmart variance. That was the last single stock variance swap trade I ever did. That was right before Bear Stearns collapsed, because the trade was with Bear Stearns. But if you want to talk to somebody who has some experience and ask them some questions, Friday's your chance. Right back here at 2 o'clock. Thanks for watching.